to speed with the carnage. We've seen institutional investors, the pre-IPO investors, lock-in periods lifting. They've been pressing the sell button. Something else to watch out for are the high-profile exits. Soon after the one-year lock-in period ended, you've had Zomato's one co-founder step down, Mohit Gupta. It's a different matter altogether. The Zomato is also laying off 3% of its workforce. Is also the head of the food delivery also resigned soon after the lock-in period ended. Nykaa is no different. The CFO has also resigned. We get to the editor's take. Nikhil Kamath now talking to you about whether you should still be a buyer for these share prices or for these stocks after we've seen the share price collapse. Is this a case of buy in the dip, or should this be a case of clear avoid at the moment? What's the larger, longer-term story? Here's the editor's take.
Every time markets think that this is it, and the supply and the real price discovery for some of the stocks will happen, the selling just in a sense the selling is rather painful and excruciating. Let me put it this way. And I think the market, while are still trying to discover the real price, and the real price discovery will always happen when the supply and demand, in a sense, the mismatch in a sense, tallies up. Last year for some of the fintech companies, there was only demand and there was no supply. And now that anchor lock-ins have opened up, the supply seems to be coming back. But more than supply, I think there isn't desperation. There is a desperation by existing anchor investors and global funds that, we got a call wrong in some of these stocks and it's a global phenomenon, and we're going to dump these stocks and we will sell, and then we will ask questions. We will exit our positions and we will take a painful loss. I think that is the psychology with some of the long investors in some of the fintech stocks. The global environment is not aiding, and then when you see headlines where the Nykaa CFO resigns, Zomato is cutting workforce, these headlines in a sense are making markets worried.
Right, so let's talk more about that big sell-off that we're seeing in the new age companies. Most of them listed about just a little over a year ago. To talk more about this, I'm being joined by Nikhil Kamath of Zerodha, as well as Siddharth Pai of 314 Capital. Welcome, guys, to the show. I want to ask straight up, can we make this a bull versus bear? Because I do know that Siddharth is still very bullish on this space. And Nikhil, are you bearish?
Always, perpetually.
You like to joke about that, right?
No, I feel like I've been a bear for so long that it's become second nature to me now. And it feels like the easier answer coming out of my mouth.
Okay, now let's get down to business. I'll begin with you, Siddharth, because you're the bull in this space. And I'm assuming you're a bull because of the long-term story, maybe as far as consumer tech goes. But if you were to go from a Zomato to a Nykaa to a Policy Bazaar to now a Paytm, it's just not looking good. And retail investors have obviously lost a lot of money. So have the institutional investors. So why are you a bit bull now? Is this a case of the right price being discovered?
So Nayantara, that's actually a fantastic question. There is no honest way to answer that in perpetuity. I can say as of now, given the macro situation that's there and rising interest rates, the markets actually turns its attention from high growth companies to high cash flow companies itself. So I think in that entire shift and reallocation and reorganization, the portfolio we're seeing right now, most of them have actually become very bearish on the tech stocks, and they're actually going much higher on your consumer product, commodity stocks, and the like itself. We're actually seeing a huge rise in traditional businesses end up coming because traditional businesses always had the ability to actually end up generating cash. Given the fact that we've actually had a low interest rate regime for a significant amount of time, when you actually run the discounted cash flow model, if the interest rates or risk-free rates becomes fairly low, there's very little difference between generating cash flows as of now and generating higher cash flows later in the future. So patience was something that actually used to be part of the entire investing program for a substantial period of time. But given the way the macro has actually turned, especially in this year, a large amount of those equations have actually changed. And this is just a natural consequence of the portfolio rebalancing that we end up seeing. And if you recollect, we've actually had similar conversations last year as to whether these particular prices were right or not. And I also said at that point in time, these are prices that are given by the market at that point in time, and the market is the ultimate decision maker. If the market suddenly changes and believes that there's no longer value to be seen, we'll actually see a substantial erosion of value to end up going. And even if we look at the IPO documents of these companies, they've clearly stated they're not going to be making profits anytime in the future, but in the long term, they will actually end up turning profitable and deliver upon the promise of tech itself. So these have never been short-term investments. For a long-term investor, they still have to look at the fundamentals of these businesses. Not all the companies you mentioned are cut from the same cloth, and they need to actually make their decisions to invest or stay invested based on actual fundamentals rather than looking only at momentum or what the market ends up dictating as of a particular point in time.
Okay. Nikhil, what about you? You've been pretty vociferous about this, that, as far as the new age companies go, the valuations, some of it absolutely not making sense. So the big question also is, there was a momentum. There was a momentum that we were seeing in the equity markets, a momentum towards these new age companies, which are also very large brands, household names. There was an argument that are this valuation so stretched? Merchant bankers were able to convince the street. So today what we're seeing, is it the correct price discovery? Same question I'm asking you that I asked Siddharth.
Yeah, so Nayantara, I took issue to many of the things which happened when these companies IPO'd. I didn't like the fact that a lot of them were OFS. They were taking out liquidity. They were secondary rounds, but they were not really investing that much money back into the business. I did not like the multiples that retail were offered. I don't think there was enough room for retail to benefit in a significant manner. That being said, if you were to ask me in terms of relative valuation, today I think Indian private equity is really expensive. Indian public equity is expensive, but less than private. But as an investor who has access to investing in asset classes across the world, things like, Meta companies on the NASDAQ, which are trading at 10, 11 times multiples, and in many ways are a lot more innovative, and innovations actually, born there to a certain extent. One would have to be really hard pressed to pick, say, a domestic tech company which listed recently over something which is on the NASDAQ and as cheap as it is today.
So Nikhil, before I go back to Siddharth, let me ask you just one other question. When we saw, like it's a Nykaa that fell below 1,000 rupees a share before it went ahead and did the stock split, a Paytm which is now available for 450 rupees versus 2,000 rupee plus as far as the IPO goes, delivery, policy bazaar. Can I ask you, like when these crashes happened, did you think it was the right time to enter? Did you look at it? Because people follow you a lot.
None of them are significantly profitable yet. I would say what Sid was saying earlier on, that when the cost of money, say, was zero, it was easier to take a bet saying, okay, this company will be profitable 5 years from now, and that is okay. But cost of capital has gone up as much as it has, it's like multifold. One might not be willing to take that bet today. So a large number of the companies you mentioned are still not profitable. Even when they do get profitable, I think they will have to scale up slowly. For that reason, I think there might be more pain which is left on.
Siddharth, come in here. I know you were traveling to Silicon Valley also recently, and you've come back from a trip. More pain? Because, there is enough pain. Not just for the retail investors that we're looking at, but just the way the companies themselves are having to reinvent, let go of staff. Thousands and thousands and thousands of people have lost their jobs in the last couple of months.
Now, one of the biggest issues with tech has been this really silly mantra that we actually inherited from the Valley, which was actually move fast and break things. So when move fast and break things that was fueled by really, really cheap capital ended up actually creating this sort of bubble that's actually burst right about now. But despite that entire bubble and bubble being monopolized by certain companies who've taken undue advantage of it, there's still a large amount of relative value that does actually end up existing over there. In fact, when I was doing my travels and meeting investors, most of the world's actually looking at Indian enterprise tech, and Indian SaaS as one of the breakouts that will actually end up creating the bull run that we should hopefully start seeing sometime in the near future itself. They've actually seen that the ability for tech to deliver high cash flows and high margins has actually been strong. What we've actually seen in Indian consumer tech is unfortunately a large amount of it didn't actually become a battle of innovation, it became a battle of capital. If I could raise a larger sum of money than the other person, let me just undercut them when it comes to price. Let me get a larger market share, and then let me figure out monetization after. So that was a move fast, break things kind of thing that actually became the paradigm. Given the fact that we've actually broken everything right about now, all the entrepreneurs in every single boardroom is actually becoming more capital efficient. And they're saying, look, there's no point actually trying to subsidize the Indian consumer. In fact, there was a joke that was going around a couple of years back that Indian startups have actually been the greatest transfer of wealth from Western pensioners to Indian consumers, because all the money that's actually come in from these larger institution companies has actually gone directly to the pockets of customers through the discounts and the cashbacks they actually ended up offering. Everyone knew that was an unsustainable business model, including the entrepreneurs themselves. So I don't think it's fair to paint the entire system as part of the ecosystem through that entire brush itself. There are still large pockets of innovation that are capital efficient, and by virtue of being capital efficient, don't end up raising the same amount of cash as some of the other peers. That's why they don't get the same kind of market. They don't get the same kind of market, I would say, visibility when it comes to that. But there are still deep pockets of innovation. I respectfully disagree with what Nikhil's actually said, that the innovation is only there in the West for that matter. Silicon Valley is built for the first 1 billion. India can actually build for the next 6 billion. And we do have the smartest minds in the country actually working on that as we.
Nikhil, you're also one of them, right? What you and Nitin have done at Zerodha is unbelievable. And you guys have done it being bootstrapped. You've disrupted the place. You've taken business away from the big boys, the old boys, that of course had the first mover advantage. So I think he's right telling you that he disagrees. You've shown yourself.
Well, in that sense, I'm guessing Sid is right. I met it in a broader manner. E-hailing in a very similar form that was available in the West. There were discount brokers in the West. There were e-commerce players in the West. There were food aggregators in the West. The ones which have thrived and done really well in India, I want to paint a rosy picture of India. I live here as well and I love the country and all of that. But a lot of what we have built here in many different domains, certain euphemized manner products which have existed in the West and they've replicated better. And these companies have really grown and done well in India, notwithstanding the effort of the promoters and the innovators here who have kind of made the product better and built it to scale. So I'm not saying there's no innovation in India, but the point I'm trying to make is maybe innovation is not happening in the manner that it is available in NASDAQ listed companies, for example. So the point I'm trying to make is if I had $100 to allocate and you put a gun on my head and I had to pick where to put that money, I would probably put 50 in NASDAQ, 30 in Indian equity, public equity, and 20 in private equity, because that's how I relatively value them from cheap to expensive today.
So 50 you would do in NASDAQ, 30 for equities in India, and 20 for the private markets. So what's your mantra, Siddharth Pai? It would be great to hear that. You guys have a fund too.
Yeah, but our fund by SEBI restrictions is actually completely unlisted, right? So it wouldn't be a fair comparison to end up making. But I do agree with what Nikhil's actually said. I just want to add another flavor to that. See, given the fact that Meta has actually dipped significantly, and it has been a cash flow generating company for a long time, relatively as of now, there is greater value you can actually end up seeing in a stock like Meta, for example, versus some of the Indian comparables you end up seeing in India. So like I said, value and valuation are actually as of a certain point in time. The amount of money that the US tech giants have actually shed is actually more than the combined market cap of most of the companies, the tech companies and startups that exist in India. It's just a much larger market that ends up being there. And the vicissitudes of the market end up actually becoming stronger. And to the point of innovation that he's also mentioned, see, if you look at WeChat and Tencent, for example, one of the most innovative companies to come out of China, they started off as a messenger app, and we've had AOL, Yahoo Messenger, everything for the longest period of time. The thing about the internet business model is, as you start off, you may end up actually copying or imitating something that exists somewhere in the world. But it's a level of research you put in and localization and understanding customers that ends up actually dictating your business model actually going forward. So there is a difference between a Ola and an Uber. Ola started succeeding in India largely because Ola started offering cash on delivery, and Uber was always the premier one that only actually generated on card. Ola forced Uber to change its model to start accepting cash in India, which is actually a massive innovation compared to what we've actually seen in the rest of the world itself. We've actually seen similar companies like Q&A, for example, trying to take on Twitter by actually creating it in terms of local languages and adherence to local law, rather than Twitter's infamous statement of the fact that we know better than the regulator that comes as part of that. So I think initially copied are fine. The execution needs to end up being specific to the area you end up operating. And Indian entrepreneurs, especially as of now, with the new age, with the companies that have gotten funded over the last couple of years, and other unicorns, maybe not the unicorns, we're actually creating the next wave that will actually end up monopolizing the conversation going forward. So the long-term bullishness as a long-term investor does actually remain. But I do agree with what he said is in terms of relatively as of now, the US markets are actually cheaper than India because they've had a much larger sell-off compared to what the Indian markets have suffered.
Fair point. And then Nikhil, I'll come to you. You told us how you would, invest your money. But, you, as well as your brother, during the IPOs last year, were also talking about how these companies, from a Nykaa to a Zomato, to Paytm, etc., had helped bring new retail investors to the public markets, right? You had talked about how some of them are women. You had talked about their age as well. Now what? Now when there's this meltdown and they've lost, 50 to 80%?
Well, I think we were largely critical of valuations even back then. And even where they sit today, we continue to remain skeptical. See, Nayantara, this is a complex world for a retail investor. Somebody has to take their side. Now, if I ran a venture capital fund, I would have to say more upbeat things about the ecosystem because my source of revenue, my source of money coming in is somewhere else. But from keeping the retail in mind, I think the valuations that were offered to them when these companies listed, in my opinion, were not totally fair. And is every retail participant savvy enough to research and figure out for himself what valuation is right and what isn't? And like I was mentioning earlier, I did not like the fact that 80% of these issues were OFS. They were the initial investors downloading or offloading to retail. It was not money which was going back to the company in the form of capex. So I do take issue to some of these small things because I think in a certain manner I speak for the retail audience and the public equity focused audience. But I think this has been a learning for each and every one of us and the retail participants in the country. The next time an IPO were to come about and say profitability is 5, 10, 15 years away, I think one would be wise to be a little bit more skeptical than we have been in the past.
Nayantara, I think one point to also add over here, kudos to SEBI for the fact that SEBI has a rule that in case the company is not profitable for a certain period of time, they actually curtail the retail participation in the initial IPO itself. So SEBI has also taken a call saying the markets determine valuation, but retail investors need to be protected in that regard. So I think the protection was actually something SEBI's taken. SEBI's actually done very well, and it's actually muted the loss. One of the biggest issues that I'm sure both Nikhil and Nathan have actually spoken about it is the fact that when the knives are actually following, that's when retail investors actually put out their hands and try and actually buying these particular stocks. So I think it's important for them to actually start looking at a more structured way of actually managing some of their cash. Because like I said, the bull run we've actually had for the near time has made everyone forget the fact that markets can go down the same way they actually end up going up. And just because it goes down, you end up in a value trap doesn't exactly mean it's always going to bounce back up. So retail, like even the investor education part that needs to go in for retail investors, I think a lot more work. I mean, the Zerodha Varsity has a fantastic program on this, and I strongly encourage everyone to actually end up looking at that entire thing itself. Getting that sort of understanding from the retail part will actually prevent them from falling victim to the vagaries of the market. Because institutional investors, despite understanding this, will suffer, but the pain that retail investors feel is actually a lot more, and we should actually work to ensure that we don't actually end up suffering unduly because of the market vicissitudes we see in the market itself.
And one would imagine that in 2023, we will have to see a couple of these listings because, institutional investors are VC money is pressing for exits. So let's see if they're all listening, if lessons have been learned also from 2021. But Nikhil, having said that, I remember last year also, there was a lot of this chatter that was happening. And, you should buy into these companies because the Nifty composition, the Sensex composition, a few years from now will be very, very different. And it's going to be made up by these companies. Do you think that's going to be still the situation?
I think that's nonsense, Nayantara. Like when people say inclusion in MSCI, Nifty, Sensex, short-term fund movement from one place to another, I think for investors is largely irrelevant. I think we need to go back to the basics. In the last few years, people have gotten swayed by the prospect of what might happen tomorrow, and we are betting today like tomorrow has already occurred. I think we need to go back to a time where we looked at, okay, this company has been around for 5 years. This is the profit it made this year, last year. This is the rate of growth, and value companies based on that. I'm often a big fan of simplicity, and the simplest things tend to work best for investors more often than not.
Sometimes things less is more. Simple is always better than complex. We're running out of time. So it's going to be my final question. And Sid, I'm going to give you this one. ESOPs is the currency of the startup universe, right? Now, with what's happening on the stock markets, where is all of this going to leave the ESOPs, and where is it going to leave the employees?
So I think the good thing is most of the ESOPs have actually been afforded at a discount to the issue price itself. So I think most of them, some of them should actually end up being in the money now. I think given for some of the companies, they may actually be out of the money itself. And I think it is a question that employees should actually start asking management also. And I think those conversations have already started as part of that itself. But I think given the fact that ESOPs, these are listed ESOPs after all, the ability for these companies to actually turn around when market conditions end up changing, we should see these companies, a subset of these companies rather, end up actually rallying much more strongly. Most of them have actually gone from chanting about growth to speaking about profitability, and we see the losses actually narrow as a function of time. So I think this is a sign of maturity on the management side also, and management's also understood the consequences of that entire piece itself. I think the employees putting pressure on the management to ensure that the ESOPs come back into the black, I think it's an added incentive from the management side to ensure that their operations end up actually scaling to what the market actually demands of them as of now. Because some of the founders, unfortunately, have made very uncharitable comments such as, I'm not going to actually, I'm only going to speak to analysts once a year. I'm not going to do quarterly calls with them, etc. What I think most founders have understood now that an IPO is not actually the end of the road, it's actually the beginning of an entire journey. So whatever marketing they've had to do previously, they no longer do it only when they fundraise. They need to do that on a quarterly basis. I think bringing that disciplines and credence in will actually end up ensuring that the market builds a lot more comfort with these business models, and they may end up giving them a slightly more leeway for them to actually end up finding themselves and delving upon the promise of tech itself.
Okay, so let's see what happens next. We got to the bull versus bear case for the carnage that we're seeing when it comes to the tech stocks in India. The trend, of course, started on the NASDAQ. Thank you, gentlemen, for giving us time today.
Thanks so much.